And gentlemen, thank you for standing by and welcome to the RealReal's first quarter 2022 earnings results conference call. At this time, all participants' lines are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question during the session, you will need to press star one on your telephone. If you require any further assistance, please press star zero. I would now like to hand the conference over to your first speaker today, Caitlin Howe, Vice President of Investor Relations. Thank you. Please go ahead, ma'am.
Thank you, operator. Joining me today to discuss our results for the period ended March 31st, 2022, are Founder and CEO Julie Wainwright, President Rati Levesque, and Chief Financial Officer Robert Julian. Before we begin, I would like to remind you that during today's call, we will make forward-looking statements which involve known and unknown risks and uncertainties. Our actual results may differ materially from those suggested in such statements. You can find more information about these risks, uncertainties, and other factors that could affect our operating results in the company's most recent Form 10-K and subsequent quarterly reports on Form 10-Q. Today's presentation will also include certain non-GAAP financial measures, both historical and forward-looking, for which historical financial measures we have provided reconciliations to the most comparable GAAP measures in our earnings press release. In addition to the earnings press release, we issued a stockholder letter earlier today, both of which are available on our investor relations website. I would now like to turn the call over to Julie Wainwright, Chief Executive Officer of The RealReal, for introductory remarks, and then we will go directly into a question and answer session. Julie?
Thank you, Caitlin, and thank you to everyone joining our earnings call today. Before we get into the quarter's results, I want to take a moment to acknowledge the ongoing humanitarian crisis in Ukraine. Our thoughts are with those impacted by this devastating war, and we wish for a resolution to this conflict and a return to peace in the region. Today, we are pleased to announce better than anticipated financial results for the first quarter of 2022. During the quarter, we delivered solid top-line growth despite COVID-related staff call-outs in our authentication centers early in the first quarter. Since supply drives demand, our return to normal staffing levels resulted in strong demand on our platform due to increased inventory. GMV was driven by fine jewelry and watches, high-value handbags, and strong growth rates in women's apparel and shoes. Of note, the RealReal sales in apparel are contrary to e-commerce reported retail trends. Importantly, during the first quarter, we also continued to generate significant operating expense leverage on both fixed and variable costs. After better than anticipated financial results in the first quarter, we are pleased to confirm our full year guidance and provide guidance for the second quarter of 2022. Notably, we continue to project The RealReal will be profitable on an adjusted EBITDA basis in 2024, and we are on track to achieve our Vision 2025 targets. These targets and projections rely on a number of assumptions. Number one, continued top-line growth of at least 30%. Number two, operational excellence with improved variable cost productivity. And number three, laser-focused discipline on fixed costs. We note that The RealReal delivered on all three of these points in our first quarter 2022 results. The near-term risks to the business continue to be inflationary pressures on our transportation costs and attracting and retaining sales and operational talent. For transportation costs, we are taking immediate steps to offset these increases. For sales and ops hiring, we exited the quarter in good shape. However, we are actively recruiting to fill positions as we grow. Looking forward, we continue to see strong demand in our business. As inflation has ramped up and prices have increased in the primary luxury market, we believe The RealReal is a demonstrated value option, offering unique and highly coveted items within the luxury goods space. Therefore, we believe we are positioned for a strong 2022. And with that, we will now go into our Q&A session.
Thank you. At this time, if you would like to ask a question, please press star followed by the number 1 on your telephone keypad. Again, that is star then the number 1. To withdraw your question, please press the pound or hash key. Please stand by while we compile the Q&A roster. Your first question comes from the line of Anna Andreeva with Needham. Your line is open.
Great. Thank you so much, and congrats. Operating great in tough environment. We had a couple of questions. The number of new buyers accelerated this quarter. Can you talk about the behavior of these buyers compared to the previous cohorts? And curious if you're seeing a bigger trade down from the primary market. And just to follow up on guidance for 2Q, you're guiding for roughly similar run rate in GMV, despite lapping a much tougher compare. Just curious, what are you seeing in the business quarter to date, just given we've been hearing a lot of negative sentiment in the consumer space? Thank you so much.
We'll let Robert answer the second part. You should also recognize that when we are giving guidance for Q2, we are now, 5 weeks into Q2. So we wouldn't give guidance if we didn't have strong faith in our quarterly estimate. But to your first question about new buyers and cohorts, look, we measure our cohorts over time. The new buyers are acting, in the first quarter of buying just the same as the other buyers. The biggest shift in our business has been more apparel, which is actually growing at an incredibly fast rate, and up to where it was pre-COVID times. So apparel has a shift, but the new buyers are acting like our previous cohort, so there's no change there. The trade down from the primary market, hard to measure. Our premise has always been that when inflation hit or a recession, that we were going to be a beneficiary of both because we are a value player. So our demand is strong, and it's really tied to us having inventory in the site. But again, we have no way of tracking our people switching their purchasing power, purchase from primary to secondary. I can tell you in the past, people have moved away from fast fashion, and we'll ask people these questions and monitor that. We do it every year, so that survey will go out sometime in May. Now let's go to guidance for Q2. Robert?
Yeah, thanks for the question, Anna. We feel comfortable with our guidance for Q2 on the top line. The projection is about 33.5% of growth in GMV for Q2 versus last year. We feel that's very achievable. It's in the range of what we talked about, 30+% growth. So we feel good about where we're projected. As Julie mentioned, we're a month into the quarter at this point, so we actually have one of the 3 months in the books, and we feel good about the trends and the projections that we're seeing.
Great. Thank you so much. Can I just squeeze another one? Just to follow up on direct sales, I think the highest as percent of GMV it's ever been. How should we think about the mix just for the balance of the year, especially as looking at inventory that's growing in line with sales now this quarter?
Yes. So direct revenue as percent of total revenue was in fact higher than normal. In Q1, it was about 34% of our total revenue, and last year in Q1 it was 25%. That's really a function of sell-through. So the inventory that we had on hand sold through at a higher rate than we expected, and that did drive that percentage up in terms of the proportion of our total revenue coming from direct. We do anticipate, as the year progresses, for that percentage to come down. The absolute amount of direct revenue stays relatively constant throughout the year. It becomes a little bit of a different comparison because direct revenue started to grow in the second half of last year, and so the growth rate will decline as the comparison changes. And we do anticipate over time that direct revenue, percent of total revenue, will go down. We do have initiatives that we had mentioned before that we are de-emphasizing the direct business in favor of our consigned business model. And we do have initiatives to reduce that over time. There will always be some portion of our business that will be direct. There is direct revenue comes from out-of-policy returns. There is direct revenue that comes from things like Get Paid Now. That will continue and will probably grow in proportion of our top line as time goes on. The part of our business, direct business, is driven by purchases from vendors and wholesalers, so on. We will de-emphasize it. But in general, overall, that percentage should come down over time, and we project that for the second half of the year as well.
Okay, that's super helpful. Thank you so much, guys.
And our next question comes from the line of Michael Binetti with Credit Suisse. Your line is open.
Hey, guys. Thanks for taking our questions here. So I think you sound confident in where 2Q is headed, but as we try to look at it on a 3-year basis to think about what the growth rates have been here quarter to quarter relative to the pre-COVID world, it looks like you're baking in a bit of an acceleration in 2Q and then a little more in the second half on that basis. Maybe just a little help, because there's obviously been a lot of noise in the retail marketplace in the U.S. at least, and a couple of the other analysts have mentioned as well. But maybe just a little help in 2Q and what you're seeing in the top line dynamics unfolding since the end of the quarter in March that boost your confidence in 2Q.
Yeah. Hey, before we get going, one of the things I do want to comment, we're in a different sector than we get lumped in with e-commerce quite a bit, and we're not an e-commerce business. We're a marketplace business, and we're on the high end of the marketplace business. And we do sell unique products that don't have multiples. So some of the basic retail credit card debt, it really doesn't apply to us, and we have been countering that. So whenever we certainly are aware of what's going on in the normal e-commerce business. We're certainly paying attention to everyone's earnings reports, but they don't map to our business really as because of where we sit as a marketplace and a value play in the luxury space with unique products. So, to be honest, one other bit of for people that are really getting in and understanding our business, we also don't necessarily map to what happens in the peer-to-peer marketplaces, which have more margin pressure on them than we do, and certainly have different price points than we do. So with that, I'm going to turn it over to Robert.
So, Michael, we've talked before about really not liking the 2-year and 3-year stack view of our revenue, given the very unusual result that we had in 2020 due to COVID. And if you look at our growth rate in Q2 of 2020 versus 19, it was minus 20%. And then in 2021, it was plus 92%. And now we're saying in Q2 of 2022, it's plus 33.5%, as I mentioned before. And I think that's a return to normal. I don't think it's an unusual growth rate or a change in what we would expect long-term and going forward. And also, I would say that the calendarization of our GMV over the year and by quarter is very consistent with what you would see in a typical year. Even in the strange years in 2020, the proportion of our revenue that comes in each of the quarters, what we're projecting now is very consistent with that. So for those reasons, I feel confident that we have a good and accurate forecast for Q2 top line.
And then I guess to follow that, Julie, to latch on to your comments about thoughts on trade down, are you seeing any signs of trade down within your business as you look across the different classifications and categories? I guess in a perverse way, that could be a good thing to see within your ecosystem, as it probably means you get on more people's radar outside the ecosystem if budgets start to tighten.
No, what we've seen, though, is more, and I don't think this will, as we stated earlier, we're selling more apparel, which has a more natural lower price point than a fine jewelry or a handbag, but it has a higher take rate for us. So our apparel did start returning to normal last quarter. Q4, it started returning to normal, but now in Q1, we're back to normal, and those trends continued in April. So it's more of a category shift mix than it is a trade down.
Okay. Thanks a lot for the help.
Your next question comes from the line of Lauren Schenk with Morgan Stanley. Your line is open.
Great, thanks. Could you talk a little bit about supply trends that you saw in 1Q relative to the fourth quarter, and then if you could update us on sort of the supply mix that you're seeing, and then just lastly on the ending inventory balance, you mentioned you're expecting to continue to work through that over the next few quarters. Could you maybe help us break down how much of that inventory is vendor versus the direct buy, the buy now and the returns piece? Thank you.
Yeah, sure. I'm going to have Robert take the second part of that question, but this is Brachi. I'll take the first part. As far as supply trends are concerned, they were similar to last year in Q1. Supply was quite healthy. I think we talked about that. We did have some issues getting the product up on the site because of labor shortages, but that's behind us now. As far as supply mix goes, seeing the same trend. We are seeing more ready-to-wear, as Julie mentioned, on the seller side as well. 30% of our sellers continue to come from stores, so that's quite healthy. And in-home is back to pre-COVID numbers, if not healthier. So all the trends, we target a lot of KPIs in supply, whether that's average unit pickup or conversion, supply mix, value, and all of those are quite healthy for Q1.
And Lauren, your question about the makeup of our inventory by the different buckets that we categorize. About 60% of our total owned inventory is from vendor purchased or wholesale activity. About 25% of our inventory balance is from get paid now, buy up front, or I'll throw in what I'll call recovered inventory, which is an operational sort of issue. And about 15% of the total inventory balance is due to out of policy. And that's just as stated on the balance sheet of the $73 million. That's a breakdown by category.
Okay, great. And just one follow-up. Where do you see that vendor mix going over the next couple of quarters?
We see it declining, fairly significantly.
Great, thanks.
Your next question comes from the line of Kunal Madhukar with UBS. Your line is open.
Hi, thanks for taking my questions. A couple of, if I could, just a follow-up on the inventory side. So obviously you sold through much more of your inventory than you expected. So was this unexpected? But the inventory overall only increased by about $2 million, $2.5 million. So was the unexpected inventory coming more from like get paid now, or was it more like return out of policy? And then as we look ahead to the future in the next few years, one of the things that's in there is an expectation that you will be able to deliver 30% plus growth on GMV, period after period, year after year. As we think about a worsening macro outlook, which a lot of people are talking about, and Julie kind of referred to it, in terms of the more value conscious kind of consumers. So how does it impact the wallet share for the more value conscious people? Will they be more impacted by inflation and downturn, and so may just exit the market completely?
Oh, gosh. All right, I'm going to answer the last. We always look to what happens in the luxury space. The luxury business is one of the most resilient businesses. We're not in a Me Too, low-cost, bottom dollar business, which is impacted by different things. But the luxury business is tremendously resilient. And we have a phenomenal flywheel where our buyers become sellers and our sellers become buyers, which gives us confidence. The other thing we always look at is what's happening in the funnel in terms of the beginning of us getting a lead for consignment. And that actually is very, very healthy. We don't expect that to change. You can imagine that some people are going to sell their things because they need the money. Other people are going to sell their things to buy new things. But I don't see our end of the market being hit in this market, we would have seen there. I know of businesses that if the market drops, and clearly the market has been dropping, where their business evaporates. We have not seen that on our side of the business at all, and the luxury market is phenomenally resilient. The reason we're confident about our growth is because of our low penetration rate overall. So we have less than 2% of potential consigners in the U.S., and over 40% of our consigners that consign with us are first-time consigners. That's been almost since the beginning of time. So we're still introducing the market, introducing people to the whole value of consigning and that they have trapped value in their house. Once they start consigning with us, they tend to continue. As you know, our consigners have a high purchase rate on our site. They're our most valuable customers, but we're also converting more buyers to become consigners. So we are very confident about the future growth. We're very confident about our positioning. And with that, I'm going to turn it over to Robert to talk about the other issue.
Yeah, so Canal, the question was about where inventory grew in spite of the higher sales through. So using the same categories that I gave before in terms of where our direct revenue is, the own direct revenue, I would say that about 60% of the growth in inventory from the end of the year to end of Q1 came from the get paid now, buy up front, recovered category. And then the remaining 40% was split equally between out-of-policy returns and the vendor purchased in wholesale category.
Got it. Thank you so much.
Your next question comes from the line of Simeon Siegel with BMO Capital Markets. Your line is open.
Thanks. Hey, everyone. So I saw the AOV. Did you say how like-for-like ASP is to normalize for mix? And then I don't know if we're still talking about GP per order, but just any thoughts on how to think about that going forward? Thanks a lot.
I guess I'll start on the gross profit per order because you guys know that's not my favorite metric. I think the gross profit per order in Q1 was about $95. That was, I believe it was an increase year over year, but
it was $90.
Down.
Yeah, 90.
90 was, I think it was 85 last year, so it's about a $5 increase year over year.
Yep.
And again, it's not my favorite metric because it sort of ignores our entire cost base when you're talking about our path to profitability, but it was up year over year. I think it might have been down slightly sequentially.
And then I can take the first question around AOP and ASP. AOV is up year over year and since 2019, and there really is just an inverse relationship between units per transaction and ASP. So we did see that go up, driven out of units per transaction. And then ASP for like items, we are getting smarter. We have awesome technology, which you heard about at Investor Day around testing higher prices around average selling prices. It's all machine learning driven, and we feel really good about that. And when we control for mix, we do see average selling price up.
And I know, thank you. That's great. And then I know the take rate tends to be the function of the the ASP within the AOV. So how are we thinking about any changes or any opportunities on the take rate side?
Yeah, we do think there's some opportunities there, and we're looking at it now because we do have some areas where we don't have a lot of competition, but we haven't completely finalized. But we do think there's some opportunities on the take rate side, mostly on the low end of the product spectrum.
And we did take an action.
Yeah, take rate now is up. Yes, driven out of more ready-to-wear, but it's also driven by the change we made last year in taking more commission on low-priced goods as well as unbranded jewelry.
And we think on low-priced goods, there's still an opportunity. When I say low-priced, I mean very low-priced.
Perfect. Thanks a lot, everyone. Good luck for the rest of the year.
Thank you.
Your next question comes from the line of Susan Anderson with B. Riley. Your line is open.
Hi, good afternoon. Alec Legg on for Susan. My first question, just on the going back to the direct revenue, is there any major difference between the vendor, the paid now option, and the out-of-policy return margins?
There are certainly different margins by category in the owned inventory. The margin, it's a competitive market in terms of what we can buy items for and expected gross margin. So there are, I wouldn't say it's by the difference between paid now or vendor and wholesale, but it's different gross margins by product category, certainly.
Okay, and then this quarter, like you mentioned, a lot of operating leverage. How much of that was driven by fixed leverage versus, say, improving your variable cost productivity?
Yeah, so we saw very nice fixed cost leverage in the quarter versus prior year. In round numbers, roughly 1,600 basis points on that part of our cost base. And we saw very nice productivity on our variable cost base, another 250 basis points, which stated in terms of variable cost productivity, it was almost 7% productivity on our variable cost base. And between the two of them, we saw 1,870, almost 1,900 basis points of leverage on our operating expenses in the quarter versus prior year.
Perfect, very helpful. And then my last question, just on the neighborhood store strategy. How many stores do you have now, and thoughts for the future? And then any metrics around the stores you can share this quarter?
Sure. We have 16 stores right now that are shoppable. We also have 3 luxury consignment offices. That's a place where you can just go in and drop off your goods or meet with an expert. They're supply driven. And yeah, I mean, our strategy on stores are the same as last quarter. We're opportunistic as far as locations go. If we find real estate that looks enticing, we'll definitely take them up on it. 30% of our sellers continue to come from the stores, and both on the supply and demand side, quite healthy there.
But our goal is we're estimating this year may be done, because unless we have an extraordinary lease that falls our way, but it's about two stores per year going forward of new openings.
Perfect, thank you. Best of luck rest of the year.
Thanks.
Your next question comes from the line of Michael McGovern with Bank of America. Your line is open.
Hey, thanks for taking my question. I have 2. The first one, I think the consignment take rate was up pretty significantly year on year, but the consignment gross margin was still down slightly. I was just wondering if there's anything to call out for either of those on the consignment side. And then just for your full year EBITDA guidance, obviously implies some margin improvement. So can you just remind us of the fixed cost leverage versus variable cost productivity gains that are underpinning that kind of margin improvement through the end of the year? I guess what kind of change should we put into our model? Thank you.
So on consignment take rate, that is largely a function of mix. When you see our take rate going up or down, it's almost always just a mix of category between high take rate items versus low take rate items. And if anything, on a item by item basis, we've stayed either flat or increased slightly. So that's always a question of mix. Same thing on the margin. I will say in the way we report margins in our Q, we include the shipping expense, the net shipping expense on the consigned side. That category is actually consigned and services, and the direct is a category that's clean by itself. And so a little bit of what you might see on a consigned gross margin change, again, could be mixed, but it's largely a function of there also being services and shipping, and shipping has been a headwind. What was I'm sorry, the second question on the leverage, it's variable leverage?
Going forward for the rest of the year.
I think for in the context of the full year guidance, just looking at based on my math, about $65 million in losses in the first half of the year. Then to get to the lower end of the range of full year guidance would suggest about an improvement to $35 million in losses. So I guess could you describe that kind of margin improvement, just any context you can give us for that.
Yeah, I do think you're going to continue to see the fixed cost leverage that we have seen in the past, and you're going to continue to see the support OpEx as a percent of revenue decline. Largely, that part of our cost base I've described as primarily fixed, and with the seasonality of our business and with increased top line growth on both GMV and revenue for Q3 and Q4 in the second half of the year, just mathematically, you're going to continue to see really nice leverage on that part of our cost base. And I think you should expect to continue to see the type of productivity we talked about in Investor Day, that our variable cost productivity needed to be 3 to 5%, sort of low to mid single digits. We did better than that in Q1, but I think that our current projections include that type of productivity on the variable cost base. And again, with the seasonality and the increased revenue in the second half of the year, that's what's flowing through in the improved profitability in the second half.
Got it. Thank you.
Your next question comes from the line of Ike Boruchow with Wells Fargo. Your line is open.
All right. Hey, guys. Robert, 2 questions for you. First, on the gross margin line, I know this direct revenue question's been asked to death, but I'll ask it more from a margin perspective. Can you kind of be more explicit about your gross margin expectation, both for the upcoming quarter and for the year? There's just such meaningful mix dynamics that are taking place. I think it might be helpful for us to understand exactly how to think about the gross margin line.
Yeah, so a couple of comments in answer to that question. You should see gross margin improve as the proportion of our revenue coming from the direct business declines. That is projected in our Q2 results and in the guidance we projected for Q2. And you can extrapolate, you have Q1 actuals, we've given Q2, you can extrapolate second half. And so you will see that there's a pretty significant increase in gross margin in second half versus first half. And again, it's primarily due to this declining proportion of our revenue coming from direct in the second half of the year versus the first half of the year. All very much consistent with how we projected the year and what we communicated in terms of our initiatives going forward and de-emphasizing direct. But there is a pretty significant improvement in margin in the second half versus first half due to that mix change.
But we should expect in 2Q to see another quarter of pressure, maybe not as much as Q1, but year-over-year pressure in gross margin below the 60.4 from last year, correct?
That's correct. I would say that you should see sequential improvement from Q1, but you're going to continue to see pressure on a year-over-year basis in Q2 itself, and then you'll see a lessening of that pressure in the second half versus prior year.
Got it. And when we get to the end of the year, does that kind of lead us to a flattish kind of gross margin versus the 58.5 last year?
Flattish to maybe a little down, I would say. Not significant, but
Got it.
I won't get the specific number.
Well, also because it's what sells through too.
Yeah. So maybe a little bit down, but flattish is probably within the realm of what we're projecting. Yeah.
Yeah, no, that's all I wanted. That's super helpful. And then just the last one on marketing. So you've gotten some pretty good leverage on the marketing line the past couple quarters.
Yep.
I think those compares get a little bit more challenging as we move forward in Q2 and beyond. Can you just kind of help us to how are you guys thinking about the marketing spend going forward for the rest of the year?
Marketing spend, I don't know what we said in our Investor Day. Not a lot. We have a nice flywheel effect, so we expect to see it get continuously, although not dramatically, more efficient. The variable part of marketing, the fixed cost, obviously gets very efficient. But we're doing a really good job of driving efficiencies aided by the flywheel effect, and also really smart variance of our marketing mix. So we're not as dependent on digital as other people, which has actually helped with the business.
And I would say for all the reasons that Julie just gave you, we're looking at our support OpEx and we're looking at our productivity by each functional area. And actually, marketing is one of the areas where we are getting the most productivity, the most leverage. And it's for the reasons that Julie mentioned earlier, but it's actually a really success part of our story in terms of efficiency and productivity and leverage is in the marketing group.
And we've been aided by the stores. 30% of new consigners are coming from the stores. We also get a healthy level of new buyers, and it really helps. Supply is strong from that. And we get, so the stores have aided that quite a bit.
Got it. Okay, thanks so much.
Your next question comes from the line of Tom Nikic with Wedbush Securities. Your line is open.
Hi, Ezra Wiener here on for Tom. Thanks for taking our question. Just a quick one. So you had a COVID disruption going into Q1, which at this point it seems to be mostly behind us. Yet the implied GMV growth rate for Q2 is about the same at about 31%. Is there anything that's preventing any sequential improvement here in Q2? And what really gives us confidence that there's going to be that acceleration in the second half?
Well, there's a couple of different things. I'm going to let Rati talk about this. But, one of the things in general, for the demand side, once we have supply on, so once we got back to full staffing, we got the product up on our shelves, so to speak, our virtual shelf. It really had an aggressive sell-through. So we ended the month, actually ended the quarter in a really nice way in Q1. And we expect to be on target for April. But our growth in GMV is directly tied to how many leads we have coming in and our ability to hire and retain salespeople, as I noted in my opening remarks. And so we feel good about that. It's something we've been doing for a while. You want to add more color?
Yeah, I think, on the supply side, the leads and opportunities, like Julie mentioned, are there. The top of the funnel is very healthy. And for us, it's all about hiring and, like Julie said, retention, which is, it goes ebbs and flows, as we all know, especially during COVID. But we have many things in place to mitigate that risk and keep attrition in a good spot.
Hey, Tom, and this is Caitlin. The only other thing I would add is Q2 of last year, we grew 92%.
Well, that's off a low base. The company was shut down. But the company was shut down in 2020.
Just in terms of the actual data. So our GMV growth rate in Q1 was 30.8%. Projected GMV growth in Q2 is 33.6%. But I would also encourage you to look at the revenue growth rate. So the revenue growth rate in Q1 of this year was 48.5%, and the revenue growth rate projected for Q2 is 52.3%. So we're talking about, more than 50% growth of revenue in Q2 versus prior year. And it doesn't exactly match the same percentages of GMV because of this proportion that comes from direct, which has a higher impact on revenue than it does on GMV in terms of the growth rates. But it's a pretty healthy amount of growth built into the Q2 projections.
Got it. Thank you very much.
Your next question comes from the line of Ashley Helgans with Jefferies. Your line is open.
Hi, good afternoon, and thanks for taking our question. You've talked about the price increases in the primary market driving up resale values. We're just wondering, how are consumers responding to higher prices on your platform? And then is there any way you can quantify the pricing benefit to your GMV growth? Thanks.
So I'll let Rati add more color to this, but one of the things we do is we don't try to, the way we set up and price is we try to get the optimal price, not the highest price. And what that means is we take velocity of sale into consideration. And that's really important for our consigners to know that our cadence of sell-through can be anticipated and expected, and it's consistent. It also allows us to pretty accurately forecast when we need new op centers due to running out of space. So velocity of sale is one of the measurements for the sell-through. Our velocity of sale has not dropped. In fact, if it did drop, we would lower the price. So it really is finding that balance between the highest price possible without losing velocity of sale. Do you want to add more
No,
on
I
that?
think that's right. I don't think we can quantify exactly how much like-for-like items are moving at, but that's something we're constantly testing, and we're constantly moving that bar, right? So if we price something at $5 and it's sold really quickly, we're going to test $10 next time. So we're constantly optimizing.
And overall, over time, our items have gone up, in $10 to $15 in the last 5 years. But this is it's not static at all. So it's dynamic.
Okay, great. Thanks. And if I could just throw in one more, would you expect the weaker macro backdrop to actually drive supply higher as consumers maybe look to monetize their items?
I do, but I mean that's just making a sort of a wild forecast. But I really look. Our business started in 2011, the tail end of a recession, and once people found they could monetize product in their home, that was sort of just free money sitting around. They really jumped on it. So I personally believe we are going to see, if we go into a recession or if people are feeling the impact of inflation, they'll be looking around to see what they can monetize. Clearly, there are other points of view out there, and no one knows, but we were sort of born out of a recession as a company.
Okay, great. Thanks so much.
Your next question comes from the line of Marvin Fong with BTIG. Your line is open.
Great. Thanks for taking my questions. Pretty much all of them have been asked, so I'll just ask this one on take rate. As we think about it just going forward, I know that apparel and ready-to-wear is take rate accretive. So just as we stand in the first quarter, what's your thought about mix today versus sort of the normalized rate? Do you think that there's more room for apparel and ready-wear and higher take rate items to grow as a portion of the mix, or are we just about where we should be? Thanks.
Yeah, so Marvin, this is Robert. I will tell you in our current projections as we look at Q2 and second half of the year, we do show an increasing take rate, a trend for the take rate to increase throughout the year. And again, it's a matter of mix. It's, as you said, as we sell more higher take rate items, that's reflected in the overall average take rate of the company. And without getting into specifics, I can tell you that our current projection is an increasing, a trend for the take rate to slightly increase as the year progresses. Not very large changes, a few hundred basis points, something like that, but we do see an increasing trend based on mix.
Okay, great. That's really all I had. Thanks, Robert.
Your next question comes from the line of Oliver Chen with Cowen. Your line is open.
Hi, everybody. One of our surveys at Cowen speaks to processing times as an opportunity as customers love speed. What's ahead there? Second, you made lots of great progress on automation and pricing. Would love some highlights on the lower hanging fruit that's left there. And then finally, Julie, at Columbia, we had a lot of great topics. Would just love your views on blockchain as it intersects with authentication, digital IDs, and also metaverse, given your experience in the industry. Thanks.
Okay, Razi, you're on the first part.
So the processing time is, we did have some delays in early Q1, like we mentioned, because of COVID-related impacts. I'm happy to report that processing time is back in SLA for all categories. So that's great, and our processing is about 2 weeks is our SLA. Over time, we see that even decreasing some more as we add more automation there as well. We have a vision to bring that all categories down pretty significantly over the next 3 years. So excited about that plan. And then on the automation front, like we mentioned in Investor Day, there's a few areas that we've targeted, handbags being one of them, and by the end of the year, we continue to be on track with the idea that we will be automating about 40% of all handbags. Fine jewelry, diamonds specifically, will also be mostly automated over the next 12 to 18 months, and pricing 80% of our items will be auto-priced as well. So we're making really great traction there, and we continue to be on target. I'll let Julie take the metaverse.
Oh, yeah. So we don't need to be a leader into the metaverse. I think the metaverse at this point is still a lot like Second Life. You know, it's got some real sex appeal, but it's not a place the average person's going to hang out. So we can be a follower in the metaverse. I personally, just as someone who reads a lot of neurological reports, I'm worried about people spending time in the metaverse, but that's my own personal consideration. But we would be a real deep follower in that one. On blockchain, as it relates to authentication, we've had a lot of counterfeited blockchain numbers come in, so I think that it's an interesting, I think it's too nascent to really understand the impact. I mean, at the end of the day, if people opt into this and they buy the product, they opt in to whatever they have to do into the cloud, it could be useful. It could be useful for brands to get closer to their customers. However, it may, in the case of brands who don't believe in resale, be used against the customer, and it could be a privacy issue. So I would say that the jury's out. I know everyone's pretty excited about it. I think the technology is nascent. It can be counterfeited fairly easily. I think there's customer privacy issues around it. And at the end of the day, when we look at, what does it mean for us? I mean, there are, on average, we've got, our products are about 5 years old for apparel and shoes, and after that it even gets older. So it's going to be a long time before it becomes a relevant discussion in the world that we play in. But it's something we watch. It's something we've considered adding to our products. And to be honest, the cost benefit isn't there for us. I know brands are experimenting, and they love getting closer to the consumer, and I would say, like everything, when you get close, the consumers also have to beware.
Very helpful. Thank you. Best regards.
And there are no further questions over the phone line at this time. I would now like to turn the call back to Julie for any additional and closing comments.
Thank you all for joining us today on our earnings call. In closing, I want to thank the RealReal team at all levels for their continued dedication and express my appreciation for a strong start to 22. We are looking forward to sharing other results with you and further progress on our path to profitability during our next earnings call. And then finally, I'd like to thank our more than 27 million members who are joining us on our mission to extend the life of luxury and make fashion more sustainable. It's really important. That's one of our key pillars. So thank you very much. And with that, we're going to end the call.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating, and you may now disconnect.